Short and shallow sounds like the recession a lot of people had been predicting until we didn't get even that. I'm curious how you're thinking about the field position for stocks, given that a lot of folks will say sentiment got over its skis coming into August, sitting on 20% S&P gains, seasonal weakness. We now have yields higher. What gives you the confidence this will be a viable dip?
Yeah, so what we talk about, what we're saying to clients is the macro is incredibly strong. You're right, the market is up 20%. But if you look, credit spreads are hitting, or at the end of the last month, they hit a year-to-date tight. If you look at consumers' net wealth, that is up. Furthermore, when you look at the economy overall and the cash in the system, it's still plentiful. Mike, that's not to say there aren't risks. There are plenty of risks out there, right? You were talking about some of the risks with Microsoft and, with Amazon and Apple later. We're also talking about the risk with higher rates. And again, we can get pullbacks. But at the end of the day, do we see a point of inflection with any of this? No, we don't see that point of inflection. What we see are pullbacks. We think they'll be short and shallow. And one of the things that we talk about is when we turn the calendar in September, the calendar will be stronger. That's when we have a lot of conferences. Optimism will start to build. And we could see froth start to really build at that point in time. And that's when we become concerned. But right here, right now, it's really more manageable, shallow and shorter pullbacks.
Yeah, I mean, September, or really even it's starting now, this focus on next year's potential earnings or next year's economy more broadly. And you don't think that necessarily we're going to hit bumps along the way in terms of the macro from here? I mean, I agree with you. Yeah. Everything we can observe looks like things are liquid and risk appetites are healthy, and we have a pretty good footing in the economy. But I just do wonder, with yields where they are and the Fed potentially having to do a bit more, whether it'll stay that way.
Yeah, Mike. So here are the two big risks that we see. The 10-year is making a beeline to 4.25. That's your high over the last couple of years. That's your high for a long time, right? If we get through that, then things could get sloppy. If we get some numbers, and I agree with the earlier guest, some of the reaction functions to earnings haven't been great because you've had such a great run up at this point in time. But I don't think anything's going to break. It's just more of profit taking, if you will. But the risk is that the 10-year, for some reason, continues to go higher and that people don't step in. If you look at when the 10-year made it to 4.25 back in October of last year, credit spreads were much wider. So your all-in yields were about 50 basis points higher. Maybe the current yields aren't high enough for people to step in and things get a little bit sloppy, okay? The second thing that we worry about is something good happening, is that the consumer actually starts to step up and starts to spend even more. And what that does is it starts to accelerate inflation again, and that brings the Fed back to the table toward the end of the year. But that's more of an end-of-year type issue.
Yeah, we do certainly have some time. Next Fed meeting not till like late September. So we're going to get a lot of numbers between now and then. Now, in terms of how to approach the market, I think you've been emphasizing maybe mid caps and smaller stocks or somewhere outside the very large growth names.
Yeah, so Mike, what we've been emphasizing is really mid-cap growth. We think mid-cap growth is your best risk reward. And the thing we've been focusing on is mid-cap growth. But from a sector point of view, what we've also liked is we've liked that media and entertainment group that's done exceptionally well. It still has a lot of the GARP properties that we like. It has an AI kicker. It's working. And what we want to do is we want to balance that with something defensive. And that's something defensive is healthcare or pharmaceuticals. And we think that's a good 1-2 combination. So if you're looking for a sector play, we think it's still media and entertainment, barbell with pharmaceuticals. Or if you're looking for something that's a little bit better, what we think is a better risk reward and can have some multiple expansion, it's mid-cap growth.
And in terms of the overall valuation flag that's being waved out there, people saying, how can we sustain a 19 times S&P multiple if yields are here or whatever? What is the answer? Is it just to stay away from the biggest stocks?
Yeah, that's something we've been contending with for some time. The issue and what we come back with all the time is valuation is not a catalyst. Valuation is high, and it's hard to really justify these valuations or really say that multiples are going to expand from here. And that's why we're looking at some of the other places. Media and entertainment still has a valuation that's less than the market. Pharmaceuticals does. Mid-cap growth also does. But yeah, the valuation of the overall market's a little bit troubling But at the end of the day, what we're telling clients is think about this as 1999, 2000. At that point in time, what really derailed the economy and the new economy stocks was the Fed. As the Fed got more aggressive, not less aggressive toward the end of the cycle. We're just not seeing that at this point in time. So until we see some sort of major catalyst, and that catalyst would likely be the Fed, we just don't think there's a big point of inflection.
Yeah, and that was, of course, after the S&P spent about 3 years well above 20 times earnings. So it didn't happen the moment we got there. Chris, thanks very much. Good to talk to you.